The greatest financial paradox of the modern era is that the harder investors try to beat the market, the more spectacularly they fail. For decades, ambitious individuals were told that complex analysis and rapid trading were the absolute keys to unlocking immense wealth. Yet the data reveals a counterintuitive truth. By doing absolutely nothing, by simply owning the entire market and refusing to play the game, investors have consistently conquered the very professionals who dedicate their lives to outsmarting it. The financial industry built a multi-trillion-dollar empire on the promise of superior stock picking. Wall Street historically convinced the public that active management was the only viable path to long-term prosperity. However, the relentless math of the market exposes a stark reality where highly paid analysts consistently underperform a simple, unmanaged basket of equities. The fees extracted by these experts essentially guarantee their own clients' underperformance over extended time horizons. The catalyst for this revelation was Jack Bogle. In 1976, he launched the first index mutual fund for retail investors, a concept widely mocked by the establishment as inherently un-American. Bogle argued that attempting to outsmart the broader economy was a fool's errand, inevitably eaten alive by exorbitant management fees, trading costs, and taxes. He believed that capturing the average market return at the lowest possible cost was the ultimate winning strategy. Passive investing is an approach that seeks to maximize returns over the long run by minimizing buying and selling. Instead of employing expensive analysts to find undervalued companies, an index fund simply buys and holds all the stocks in a specific benchmark, matching its performance minus a microscopic fee. This strategy eliminates the human error, emotional bias, and sheer arrogance that plagues traditional portfolio construction. This seemingly mundane strategy triggered a seismic shift in global capital flows. More than $13.8 trillion eventually migrated from expensive active funds into low-cost passive vehicles. The economic forces driving this massive migration were simple mathematics. Compounding returns without the heavy drag of high management fees mathematically guaranteed superior financial outcomes for the vast majority of participants over multiple decades. To truly understand why this strategy dominates, you must examine market efficiency. The efficient market hypothesis dictates that asset prices fully reflect all available information, making it virtually impossible to consistently achieve higher than average returns without inside information. If the collective intelligence of millions of buyers and sellers perfectly prices a stock, then active management is an entirely futile exercise in predicting the unpredictable. But here lies the profound paradox of the passive revolution. The entire system relies heavily on the price discovery mechanism provided by active investors. If everyone simply buys the index without analyzing underlying corporate fundamentals, no one is actually determining what a stock is worth. The financial ecosystem requires active participants to set accurate prices, yet ruthlessly penalizes them for their analytical efforts. As passive funds consume a larger share of global equities, severe concerns about market distortion arise. When an index fund receives fresh capital, it blindly buys shares of all companies in its benchmark, regardless of their individual valuations, debt loads, or economic outlooks. This indiscriminate capital allocation artificially inflates the share prices of the largest companies simply because they command the largest weight in the index. The S&P 500 serves as the prime example of this dangerous concentration effect. Because it is a market capitalization weighted index, the biggest technology giants dictate the vast majority of its daily movements. An investor buying a broad market index fund is increasingly taking on concentrated sector risk, effectively betting the majority of their wealth on a handful of dominant megacorporations, while believing they hold a highly diversified portfolio. This dynamic is further amplified by algorithmic trading, which is the use of complex computer programs to execute trades at superhuman speeds based on predefined criteria. These algorithms often interact with the massive, predictable capital flows of passive funds, creating automated feedback loops. During periods of extreme economic stress or sudden liquidity shocks, these interconnected systems can rapidly exacerbate market volatility, driving prices down with terrifying efficiency. The shift toward indexing also brings fiduciary duty into sharp focus. This is the stringent legal and ethical obligation of a financial professional to act strictly in the best interest of their client. Advisors bound by this duty increasingly recommend passive funds because their rock-bottom costs and predictable tracking error provide a mathematically defensible strategy. It protects the client's wealth from underperformance and shields the advisor from legal liability. The ripple effect of this capital migration profoundly alters corporate governance at the highest levels. The largest passive asset managers now hold massive, immovable voting blocks in virtually every publicly traded company on Earth. Because they cannot sell a stock if they disagree with executive leadership, they must exert influence through proxy voting, effectively making a few massive financial institutions the ultimate arbiters of global corporate behavior. This immense voting power intersects directly with sustainable investing, a strategic framework that incorporates environmental, social, and governance factors into financial decisions. Passive mega managers use their outsized voting blocks to force corporate compliance with climate initiatives and boardroom diversity mandates. They are fundamentally reshaping the global economic landscape and corporate policy without ever actively trading a single share of stock. On a macroeconomic scale, the sheer dominance of index funds alters how capital is distributed across the entire global economy. Historically, capital markets directed funds to the most innovative, promising enterprises. Today, the immense volume of passive flows ensures that capital disproportionately rewards established incumbents, potentially starving smaller, dynamic disruptors of the vital liquidity they need to scale and innovate. Consider this structural dynamic during a yield curve inversion, an economic indicator where short-term debt instruments offer higher yields than long-term instruments, universally recognized as a signal of impending recession. In the past, active managers would aggressively reposition portfolios to defensive sectors to protect capital. Today, passive funds simply ride the wave down, locking millions of investors into the exact market structure that is actively contracting. Yet, the very inefficiency created by passive dominance breeds highly lucrative new opportunities. As index funds blindly buy the largest companies, smaller or less glamorous equities frequently become severely mispriced. The active manager's new mandate is not to beat the broad market, but to exploit these specific localized inefficiencies that algorithmic trading and massive passive flows leave behind in their wake. For the ambitious individual navigating this landscape, wealth building requires profound nuance. Relying entirely on a single broad market index provides excellent low-cost exposure, but it also guarantees full participation in every market bubble. True financial acumen demands understanding the underlying mechanics of your passive vehicles and recognizing the hidden concentration risks embedded within their seemingly safe, diversified structures. Effective wealth preservation in a passively dominated market involves highly strategic asset location. You must deliberately counterbalance the massive mega-cap exposure of standard index funds with targeted investments in asset classes that indexers structurally ignore. This might include private equity, real estate, or specific emerging markets where price discovery is still driven by fundamental human analysis rather than automated capital allocation. The echoes of historical financial crises remind us that market liquidity is never an absolute guarantee. When panic strikes, passive investors who assumed they held a perfectly liquid, diversified portfolio often discover that the underlying assets cannot be sold without triggering massive price cascades. The structural integrity of the entire financial system relies heavily on active buyers willing to step in when the indexers panic. The market has evolved from a noisy form of individual stock pickers into a colossal, automated capital allocation machine. The sheer momentum of passive flows creates a powerful self-fulfilling prophecy where stocks rise simply because they are already in the index. This phenomenon completely divorces a company's market capitalization from its actual economic output, revenue generation, or intrinsic corporate value. To exploit this modern reality, you must adopt a sophisticated hybrid approach. Utilize passive funds as the low-cost foundational bedrock of your portfolio to capture broad global economic growth. Then, deploy active strategies as surgical tools to generate alpha in highly inefficient sectors, effectively using the predictable, automated behavior of the passive majority to your distinct financial advantage. You must also critically evaluate the specific internal construction of the index funds you hold. Not all passive vehicles are created equal. Some utilize complex derivatives or engage in aggressive securities lending to slightly boost returns, introducing hidden counterparty risks that completely undermine the core premise of safe, predictable, and transparent investing. Across international borders, the passive phenomenon is accelerating, but with highly uneven impacts. In heavily developed markets, indexing is the undisputed king of capital. However, in emerging economies where information is deeply asymmetric and regulatory frameworks are less robust, active management still retains a distinct, measurable advantage. The inherent efficiency of a specific market dictates the optimal strategy for conquering it. Looking ahead, the next great frontier of wealth generation will belong to those who understand market structure just as deeply as they understand corporate fundamentals. The passive revolution has permanently altered the physics of the stock market. Recognizing how these massive automated capital flows create hidden distortions will be the defining analytical skill for the next generation of elite investors. The legacy of Jack Bogle fundamentally democratized wealth creation, stripping away the exorbitant fees that once enriched Wall Street at the direct expense of Main Street. Yet, as the global market fully adapts to this new reality, your financial security requires far more than just blind participation. It demands a sophisticated, unwavering understanding of the very machine you are trusting with your economic future.